Hi, my name is Todd Jordan. I'm Managing Director with Hedgeye Risk Management, and today we've got an analyst-to-analyst discussion with Kevin Kaiser, who heads up our energy research. Kevin's no stranger to big, bold calls. He made a great call on Lynn Energy earlier this year, a negative call going up against some big hedge funds, and Kevin was exactly spot on the money. And we think he's got a pretty big call, pretty big negative call again today on Kinder Morgan. He presented to some institutional clients in the morning, presenting his thesis, and today we're going to hit the high points of that thesis. So, Kevin, welcome.
Thanks.
So let's start with Kinder Morgan and what they do. Tell us a little about the company.
Yeah, so Kinder Morgan, it's a $100 billion enterprise company, transports, handles, stores, produces oil, as well as transports and handles natural gas, coal, steel, and other bulk products. It's formed as a master limited partnership, Kinder Morgan Energy Partners, and its general partner is Kinder Morgan Inc., which is KMI.
So master limited partnership, also known as MLP.
That's right.
A lot of people are invested in these as dividend yields, correct?
Right, yeah, the prime motivation for owning an MLP is the cash that it distributes back to the unit holder. And that's known as distributable cash flow.
Okay, so I read your report, and one of your big issues is you think the amount of cash that the company's actually generating is less than what they're distributing because the way they classify maintenance CAPEX. Did I get that right?
Yeah, that's exactly right. And so when you think about how distributable cash flow or distributions are calculated, maintenance CAPEX is a major component of that. And it's my thesis that the company's maintenance CAPEX is significantly below what I think it should be.
Okay, now, so what happens? So does that mean they're borrowing to pay out this cash to the general partner?
Borrowing, yes, so increasing debt. If you look back, they increase debt about $1 billion every year, and also serial equity raises. And so this, essentially the company finances maintenance CAPEX, and that's at the crux of the issue.
So what's your sense on the difference between maybe what the investor's looking at as a dividend yield or a free cash flow yield versus what the true yield is?
Yeah, so what the investor is seeing is they're seeing a yield on DCF, distributable cash flow, and that's something like 6.5% today. But when you think about how much maintenance CAPEX the company could be financing, which I think is about $1.2 billion a year, the actual yield that the investor is getting is more like 3.5%, less than 50%. Of the nameplate yield.
So if I'm an investor, I'm looking at all this classified as expansionary CAPEX, I would expect to see a lot of growth in the business. And I know they have some E&P assets, and yet your contention is that's not even growing.
Right. So for an E&P company, and Kinder Morgan has a significant E&P business, the cost to maintain production and reserves should be maintenance CAPEX. Kinder Morgan over the last 6 years has not grown production or reserves in that business, yet they have assigned it zero maintenance CAPEX.
Wow. So essentially getting a zero return on this expansionary CAPEX, which in and of itself should be classified as maintenance CAPEX.
That's exactly right.
Wow. Okay, so if we're looking at the story going forward then, I've seen these kind of levering up stories, cash flow stories. Yeah. They can last a long time. Yep. And I think the stock has done fairly well for a while.
It's done fantastic. I mean, the investment has been really excellent, really 15 years I think it is now. And so when you think about catalysts for these types of situations, it's really hard to point to a calendar catalyst. These things just tend to stop working. Essentially they work until they don't. And so there isn't really a hard
So your call is not necessarily you have to short this stock today. It's just there are some real issues here that eventually and inevitably are going to come through. Is that correct?
That's exactly right. And I think the real call is that this is really a name that you don't want to own because I don't know when this will sort of fall apart. But I don't think anybody does, and I just think that risk is not reflected in the price.
So back to the catalysts, I'm just thinking of levering stories, and obviously they have some exposure to the price of oil, so would a drop in the price of oil potentially be a catalyst? Would higher interest rates, which is a Hedgeye call that we have, would that potentially be a catalyst?
Yeah, two things on the macro front. The company is, it generates a lot of cash flow from oil. It produces 43,000 barrels of oil a day, so oil prices will impact cash flows as well as interest rates, not only just because of MLPs are valued based on their yield, but also because Kinder Morgan Energy Partners has $11 billion of floating rate debt.
Wow, that's a big risk. A lot of long-term issues. You definitely don't want to own this one. So thanks for being with us today, and I also like to thank Kevin Kaiser. Did a terrific job. Kevin has some excellent insight consistently, and if you'd like to follow him on Twitter, his handle is Hedgeye Energy. My name is Todd Jordan, Managing Director at Hedgeye Risk Management.